There's a couple of things to consider when you're determining whether you want to buy, shares of something or whether you want to buy, calls of something. Um, so to put it kind of like in its most simplest terms, it really depends what your end goal is, because options and shares, they're very different forms of using your money to make profits. The thing with calls and puts and options is that you're paying a very high time premium, and you only have a limited amount of time to really let the play unfold and go in your favor. So for example, today I was eyeing the 3261 entry, for PLTR, um, and the reason I decided to buy calls at and shares at this level is for two reasons. Firstly, you want to buy options whenever you know a certain price has a high probability of actually having a reaction in your favor. Um, and what you want to do is you want to kind of buy the option at that price and then let it play out. And if it doesn't play out, you have to get out quick. Um, the reason I ended up buying calls, I'm sorry, shares also, is because I don't know if it's going to make the full retracement that I want, but I know that if you keep trading this within a week, 2 weeks, a month, this thing can easily clear 40 to 42, and maybe even take out the all-time highs at 45, right? So I buy shares because I know that this is going to go up and this is a good entry point for me to get in, but I'm not pressured by the time crunch to necessarily, get out of a position, right away. And so, for example, when you're trading, patterns and wedges like this, um, calls might not be very good because you don't know how long it's going to happen. You don't know how long a stock is going to trade within range before it finally breaks out, right? However, here a retracement into the moving average, that was a really good play for a call, because I was eyeing this level because this was the level of the daily moving average, and I said, you know what? There's a high probability that we get a reaction in the positive direction, and so what I'm going to do is I'm going to take this play. I'm going to buy calls as soon as it gets very close to this price, and then see what happens from there, right? And I was correct. We got a big move up. I was able to actually book some profits along the way. And then I actually ended up getting out on this red candle, because I got in and I put a trailing stop loss, and I said, okay, 20%. And then I moved it up to 15, and then moved it up to 10. And so when I moved it to 10%, when I went from the peak to here, that's when I actually ended up getting exit out of the trade. So this was a scalp. At the end of the day, this was a scalp. But the fact that you have calls, you have a high leverage scalp, meaning that if I bought 10 contracts, it's the equivalent of making um, what 1,000 shares would move, but only using a little bit of money, right? And then I also ended up buying some shares. I ended up buying some shares um, around here, and I ended up buying some shares knowing that this can reverse to about 40, 38, 42. But I'm not going to necessarily put it on the clock, and I'm not going to be stressing about how long it's going to take to get there. So I'm just going to let it, do its thing. It's probably going to chop around sideways for a while. But with the option I got in, I got out quick. I only had a little bit of time burn. And the reason I was able to scalp it here was because I knew with a high probability that there was going to be a reaction in the positive direction. We got that reaction. I made my money, and I got out. And you know that, like I said, that's going to be the case. Let me go over one more. I traded MViz. Wow, it's at 18. I traded this one. This is $6. Um, I traded this as it was coming into the moving average. Um, I ended up taking. It was a day I got in here, and I ended up getting about a 10%. The stock went up about 10% And I knew that as soon as it took off, it was going to take off. And so once it did, I got my money. Um, I didn't know how high it was going to trade. So if I would have taken some shares, I could have let this thing roll out for a couple more days. And, from here, 550 to maybe here, 650, um, it was $1, but it took about 2 to 3 weeks to get there. And you would have seen a lot of burn in your contracts. And so you lose a lot of profit. And so that's why you want to consider whether, am I trying to get to $10? If so, then I might want to buy shares and then just hold on to them maybe, for 3, 4 weeks. In this case, this stock just exploded. If you're saying, I just want to make sure, I just want to get the bounce and make a quick buck, then that's when you want to go in, with calls, because calls are risky. Um, in fact, whoever played this on this day, um, same thing. I would have taken calls at the moving average, um, gotten this leg up, booked profits, and then gotten out. Um, so that's kind of the difference when you know you have a high probability trade, and you don't care about how far it can run, or you you know that you're going to get a reaction in the positive or negative direction. you know Take the calls, put a trailing stop, and then start booking profits because you're on the clock. Or if you want to find a good entry point, then just take shares and just hold on to them, give them a couple weeks, and they'll slowly, if your technical analysis was good and the market conditions are good, then your trade will end up working out. All right, guys, I'll catch you guys in the next one.